If you look at Meta stock today, you see pure panic. The stock has not only broken below $600, it has now dropped below $550, and it is moving quickly toward the $500 level. Wall Street is terrified. In just a few short weeks, Mark Zuckerberg has faced a perfect storm of negative news. The company lost two massive lawsuits regarding child safety and social media addiction. At the same time, there are credible reports that their new artificial intelligence model, codenamed Avocado, is facing severe delays. And that is only part of the story. When you combine legal pressure, massive AI spending, a volatile macro environment, and the fact that growth stocks are falling harder in uncertain times, the result is a brutal sell-off. Investors see billions of dollars being spent on AI infrastructure. They see legal threats multiplying. They see a stock that is already under pressure, and they are hitting the sell button. However, if you are a long-term investor, this is exactly the kind of situation that creates opportunity. In this video, I'm going to show you why the market is wrong about Meta. I will break down the reasons the stock is falling, and then I will show you why this crash could be a huge opportunity. First, welcome back to Rebuild Finance. This channel is about documenting a long-term investing journey, building a portfolio over time, and sharing the real analysis behind each decision. My goal is simple: find elite businesses, buy them at fair prices, and hold them for the long run. So let's ignore the panic and look at the real situation. To understand why Meta is dropping, we need to look at the main reasons Wall Street is selling. The first reason is the legal storm. Late March 2026 was brutal for Meta's legal team. A jury in New Mexico slapped the company with a $375 million fine for misleading users. The very next day, a Los Angeles jury found Meta negligent in a landmark social media addiction trial. Now, a single fine like that is not what scares investors. For a company like Meta, $375 million is not the real problem. The real problem is what it represents. Wall Street is afraid of the domino effect. Investors worry that these cases could open the door to more lawsuits, more regulation, and more pressure on the business model itself. And that matters much more than the size of the fine. Because if Meta is forced to make its platforms less addictive, then the whole economics of the business changes. Less time scrolling means fewer ads shown. Fewer ads shown means lower revenue. And that is what the market is really pricing in. The second reason is capital expenditure. This is where the fear becomes much more serious. Investors still remember 2022 when Zuckerberg burned around $80 billion trying to build a metaverse. That project destroyed a huge amount of trust. Now, they are seeing a similar pattern with AI. Meta is projected to spend $135 billion on capital expenditures in 2026. Let that number sink in. $135 billion in 1 year. That is an enormous amount of money. And the problem is not just the spending itself. The problem is that after all that spending, their new AI model, Avocado, is still delayed. That is the real issue. If the company is spending this much money and still cannot deliver the product on time, investors start asking the obvious question: how much more money will they need? And when will they finally see the return? That is why the market is reacting so badly. The third reason is the macro environment. This is very important, and I think many people underestimate it. We are in an uncertain global market. We have tariff concerns, geopolitical tensions, and fear around inflation and growth. In this type of environment, growth stocks usually get hit harder than the rest of the market. That is simply how the market works. When times are uncertain, investors do not want aggressive growth names with huge future spending needs. They move towards safer names and they sell the higher beta stocks first. Meta is exactly the kind of stock that gets punished in this kind of market. It is a growth name. It has large future spending plans. It depends on investor confidence, so when fear rises, the stock usually falls much more than the broader market. That is why Meta can drop so hard even when the business itself is still extremely strong. Now let's move to the more important part. Why could this be a great opportunity? The first thing I want to say is that the legal panic is being exaggerated. Yes, the lawsuits are serious. Yes, the The headlines are ugly, yet the economic reality is much different from what the market is implying. Meta has around 3.6 billion daily active users, and a small group of younger users is not what drives the whole business. Children between the ages of 8 and 13 make up only a tiny percentage of the total user base. From an advertising perspective, that segment is not what really matters. What matters is that Meta is still one of the most powerful attention platforms in the world. People do not seem to be able to leave it. The product is too embedded in daily life. That is why the core business remains extremely strong. And the economic data tells us a completely different picture. Let's start with the income statement. Meta is a much leaner company than it used to be. The company cut headcount aggressively after the hiring boom. At the same time, revenue has continued to grow. That is what strong operating leverage looks like. That means every dollar of new revenue is worth more because the company is no longer carrying the same bloated cost structure it had before. Now, look at the balance sheet. Meta has a fortress balance sheet. It has a huge cash position, very manageable debt, and a lot of financial flexibility. That matters a lot in a market like this. A strong balance sheet gives the company room to keep investing, keep buying back shares, and keep absorbing temporary pressure without being forced into bad decisions. Now look at the cash flow statement. This is where Meta becomes even more interesting. The company is still generating massive operating cash flow. That means the core business is producing real money, not just accounting profits. And that cash flow gives Meta a lot of options. It can fund AI spending, it can buy back shares, it can keep rewarding shareholders, it can keep investing in the business without relying on outside funding. That is a huge advantage. And even though the market is worried about AI spending, there is another side to this story. Meta is not spending all this money on a random experiment. It is using AI to improve its core business. Better targeting, better ad performance, better engagement, better monetization. That is the real long-term thesis. So yes, the spending is very high. Yes, the delays are frustrating, but if the investment works, the returns can be enormous. There is also another point that investors should not ignore. The management team is heavily incentivized. Top executives have stock-based compensation tied to very aggressive long-term targets. That means their interests are aligned with the stock price going much higher over time. They are not being rewarded for short-term weakness. They are being rewarded for building massive long-term value, and that matters. Finally, remember this. Growth stocks usually fall harder in uncertain times, yet they also tend to recover much more aggressively when conditions improve. That is the other side of the trade. When fear disappears, these stocks often rebound much more than defensive names. So if you buy them during periods of extreme uncertainty, you can get an outsized recovery later. That is why this kind of sell-off can create such a good opportunity. So to wrap this up, Meta is being sold off for three main reasons. First, the legal pressure. Second, the huge AI spending, especially with avocado still delayed. Third, the macro environment, which is hitting growth stocks much harder than value names. However, the business itself is still extremely strong. The company has a massive user base, a fortress balance sheet, strong operating leverage, huge cash flow, and a management team that is heavily incentivized to create value. So yes, the stock is under pressure, but when you look at the fundamentals, Meta is still a great company trading at a discount. And that is exactly the kind of situation long-term investors should pay attention to. Now I want to hear from you. Do you think Meta is heading lower, or is this a massive opportunity at these levels? Let me know in the comments. If you want a more detailed analysis on Meta's financial position, check out the video on the screen. If you found this breakdown helpful, hit the like button. And if you want to follow my journey building a portfolio to $1 million, make sure you subscribe. Thanks for watching, and I will see you in the next one.